Any of you who has never done a budget? Meaning, have all of you done budgets? Hello? Hello?
Yes, sir, we did budget in our day-to-day life.
A day-to-day life, you are doing budgets. Very good. Why?
For a proper financial management with the monthly earnings.
Very good. Yeah, so what Sanjeev said is quite right. On a daily basis, we are doing our budget, right? Every day we are doing budgets. Now, for example, if you go to office, when you travel to office, right, uh, on a daily basis, do you carry about 20 million to office whenever you go to office? 20 million every day you take to office. Is it? Or do you take only a limited amount of money with you? Do you take every cent you earn to office? Answer is you don't. Why? Because you have already done your budgets. Right? You know how much you need to travel for your food, maybe for a drink. You know exactly how much you're going to spend. Or you'll have a rough estimate. Maybe you have a little more a cushion, right? So that you can have not one drink, but two drinks. Or you can buy a drink for your friend. Maybe you can have a cup of tea, isn't it? So you take something little additional also. Meaning all of us every day on a daily basis are doing budgets. Right? So there is nothing new to learn, nothing at all. My next question is, why do you do a budget? Like individuals, even organizations also do budgets. No? Usually in an organization, it is usually an annual thing, right? Usually. Um, so why would you do a budget? So budget is a document that translates plans into money. That's what why you need a budget, right? You have the plans and you want to make money out of it, right? So the way to get to the plan is through the budget. That will need to be spent to get planned activities done, and money that will need to be generated to cover the cost of getting the work done. It is an estimate or informed guess about what will be needed in monetary terms to do work, right? So it is not the actual number, it is only a guess. This process of financial planning is known as budgeting. The budget is an essential management tool. All right, my next question is, why do you do budgets? What are the benefits of budgeting? Yeah, tell me.
It's a way of managing the funds. If we are running out of funds, then we have to find ways on how to obtain the funds, and if we are having surplus of funds, and how we can make ultimate benefits out of it, like investing on other instruments like fixed deposits or treasury bonds like that.
Yeah, quite right. So you know exactly where you stand. No? In monetary terms, you can plan out all the activities for the next year or whatever the activities you envisage. And during those activities, you know how much you need to spend and the possible revenues that might come in. Right? So based on those, you know whether you have a surplus, meaning a budget surplus, or a deficit, right? A budget deficit. So if you're short of money, then you need to think of how to bridge the deficit, right? What you're going to do to bridge the deficit. Maybe you do an equity issue, right? Or perhaps you go for a debenture issue. Then it might be using a bank loan, or maybe you might dispose some of your assets, right? So there are so many ways of financing a deficit. Likewise, you can look at your surpluses. If you have a surplus, you can make plans for that as well. Right? Maybe you can do, as you rightly said, investing. Right? You might invest in treasury bills, treasury bonds, FDs, also equity. Right? So that depends on so many things like the return. You might look at the return. What is the risk you're taking when you need cash flows? Likewise, if you need to borrow, you might look at something similar, maybe the cost of borrowing. How easy is it to access the borrowing source? What is the time duration, right? Things like that. Then the documentation, the exit clauses. So many things can be planned based on your budgets, right? So what you figure out is your surplus or your deficit, and what are you going to do with the surplus, or how are you going to bridge the deficit? Things like that can be planned, right? So it's a planning tool. Very good. What else? Yeah. Anything else? Pluses and minuses of budgeting. It is obviously a planning tool. Tell me, now these are the things that you need to think of, right? You're at the exam, your examiner might test you on certain things, whether you can, just to check whether you can think a bit. Okay, so everything is difficult to teach in class. Certain things you have to develop within yourself. That is why it is important to practice things like this. Put your thinking caps on. Right? What are any advantages or disadvantages of budgeting? What else can you think of?
To drive the team for the expected targets.
Okay, very good. So it is a communication tool, right? You can communicate your targets, costs, expected. You can communicate your rewards or even your penalties. Yeah, very valid point. Right, so you can communicate expected performance. Maybe your profits. Good point. What else?
Which gives us a hint whether we have utilized the resources properly with the previous year's budget and current year's budget.
Yeah,
And based on that, we can allocate the funds appropriately.
very good. So it measures performance, isn't it? That's what you mean, right?
Yes, sir.
You know whether you have achieved your targets. Then you can compare your targets or your performance with those of competitors and your previous year's performance, things like that. That's it. It's a good tool to measure performance. Anything else you can do? It can you also be used as a feedback tool. You know whether you're getting towards your target or you're going away from your target, right? So it can be used for as a feedback tool. What else can you do? Yeah, nothing else?
Can use as a controlling tool, sir.
Very good. It's used as a controlling tool. Otherwise, you will have most of your employees going out of control. If you know exactly what their budgets are, if they know what their budgets are, they will not go beyond those control levels or those limits. What else?
It's do something like SWOT analysis.
Okay. Meaning it's an analytical tool, right? Right? Budget can be used as an analytical tool. So you can do your SWOT analysis, things like that. Based on your budgets, you will know where you're getting to, what your market share might be, what your bottom line is going to be, right? So you can do a SWOT analysis, not a backward-looking one, but a forward-looking one. A valid point. Anything else? Or even when the actual figures come out, you can compare it with your budget and see what you have done right, what you have done wrong, where you have made mistakes in your assumptions, things like that. Yeah, what else? Pluses and minuses both. We are discussing both together.
As a disadvantage, sir, it's a time-consuming job.
Very good. Consumes a lot of time. Now, normally in your organizations, who is involved in preparing budgets? Huh? Are all the trainees, new recruits, or the minor staff involved in budgeting in your organizations? Who does the budgeting? Yeah. Senior management or the junior level staff, trainees? Who does budgeting normally?
Senior management.
Senior
Very
management.
good. Yeah. So senior managers do the budgeting, right? Top level guys, the MDs, the CEOs, uh, all the heads of department get involved in budgeting. And how long would you take to do a budget normally? Can you do it in 5 minutes? Senior management type, 5 minutes. Can you do a budget in 5 minutes?
No, they need to input data, verify, and then justify. Closer
Yeah,
to
it's a time
3.
consuming process. Exactly. It takes a couple of months minimum. Maybe the senior management team might have to go out of Colombo, maybe go overseas or whatever. And the entire team takes a couple of days off. They go, most of the time they drink and all that, but in the meantime, they also do a budget. Right? They put their heads together, work on this for a couple of days. But before that, a lot of planning work has to be done. So it consumes a lot of time. And with time,
They are not reliable, and most of with the assumptions.
yeah, it consumes time. Assumptions may not hold. Maybe you did your budget expecting the exchange rate to be 200. But 3 months down the line, it may not be 200, might be something else, might be 220, might be 180. But your budget, all your numbers are based on a figure of 200. Okay, the moment it changes, lots of variables can change. What if it goes up or go down? No one knows. So your assumptions that the exchange rate will remain at 200 is not valid. That interest rates will remain at current levels may not be valid. Things might change overnight. Yeah, good point. What else?
So as a disadvantage for certain sectors, they might have allocated less amount of funds. But next year, due to certain uncertainty like COVID or something like that, they have to again replan it, pull more
Yeah,
funds into that sector.
okay. I mean, it's there can be deviations from budgets, isn't it? Although you make a certain plan, you might have to change it. Right? Like Sanjeev rightly said, things like COVID might come, things that you can never plan. Right? If that is the case, you have to be flexible enough to change it. Also, a similar point, or the same, something similar, is that budgets can be too rigid. You do a budget, you spend a couple of months, do a budget, but it might not allow you to do anything, right? Nothing at all. Your hands might be tied because the budget is too rigid, right? What else?
Staff morale may get down due to rough
Yeah,
budgets.
it might motivate. Now, if you give an unrealistic budget, a budget which from day one you are guaranteed you can never achieve, then from day one itself, the staff will not go for it. Right? You try to be ambitious, give them aggressive targets. Straight away, they will realize they are not going to achieve it. And if they don't achieve it, their bonuses, their increments, their promotions will get stuck. So they are not going to give it their best. Right? Well, on a similar, stemming from this, you can also use it as a motivational tool. Right? You can use it as a motivational tool. Maybe you can tell your staff that if you increase the bottom line by 20%, you all will get an additional commission, right? Or an additional 1 month bonus, something like that. Yeah, good point. Now, you might have the best budget in the world, right? You would use sophisticated methods, do several rounds of simulations, computer modeling, and all that, and you get a perfect budget. But what good does it serve? Sometimes it might be just the time and money that you have spent to get a perfect budget. So it serves no purpose after some point. Okay. Anything else? No? Right. Benefits of budgeting. Budget set targets. It helps people to work towards a set target. Budgets are measure of how much money is needed to carry out activities. Then budgets are a form of communication. Employees are aware of performance expectations with regards to individual work areas. Budgets acts as monitoring, coordinating, and controlling tool. By doing a variance analysis, the manager can estimate where the actual results are different from the budgeted results. It aids to plan process. It aids the planning process by providing a series of quantitative guidelines which can be followed to achieve organizational objectives. The budget forces rigorous thinking through the implications of activity planning. There are times when the realities of budgeting process force us to rethink action plans. Use properly budgets tell when certain amounts of money will be needed to carry out activities. The budget enables monitoring income and expenditure and identify any problems. Right. Then the budget is a basis for financial accountability and transparency. When everyone sees how much you should have spent and received, they can ask informed questions about discrepancies. All right. The limitations of budgeting. It is a time and cost consuming job. The development of budget includes many repetitive steps before the budget is finally approved. Compared with its cost, budgeting provides little valuable, reliable, and relevant information. Budgets are based on assumptions that often turn out to be inaccurate. Budgets also cause great deal of waste and behavioral problems. People's main goal is to meet the budget, so they always try to negotiate to get lower targets with lower sales and higher cost, which are known as padding the budget. right? So normally, just to keep everyone happy, you might tend to understate your budget, right? So that your targets are achievable and chances are you will achieve it, right? So you don't try to inflate your budget. You always try to your lower budget. Budgeting techniques. Right? So we will discuss two main budgeting techniques. There are a few more. Right? I will explain using an example. Okay, so let's just assume that you are planning a trip. You're doing a budget. Let's say there are about 5 or 6 people traveling with you, or even 10, maybe 100. Right? You normally do a budget, and then you will tell the people that it will cost you per person $10,000 for the trip. Right? So let's just do a rough budget. Let's say a trip. Where would you like to go? Yeah. Any particular place? So let's take something exotic. Um, exotic location. So let's say Pahantudar. You want to go to Pahantudar. Right? Now, what do you think would be the expenses? Let's say 2021. What are the expenses? Traveling? Let's say you hire a bus to Pahantudar, it will cost you 50,000. Food, maybe 10,000. Lodging, 10,000. Okay. Anything else for the trip? If you want to make some videos there, 10,000. Right. So total cost of the trip, 75,000. This is your budget for this year. Now, let's assume that you went on the trip and you were highly impressed. You want to do another trip next year also. This is photography or whatever. Right. You want to do another budget, another trip next year. Today itself, you start budgeting. What you do is you can assume that all your costs will increase by 10%. Every cost is going to increase by 10%. So your traveling this year cost you 50,000. Next year, how much will it cost you? Yeah,
55,000.
55,000. Food will cost you 10% on top, 11,000. Lodging 5,500. Photography will cost you 11,000. Then your total cost come to 84,000. 82,500. Right? Now you have assumed that all your expenses will increase by 10%. Everything. Across the board, you assume you have given the same treatment to all. Right? That's one way of doing it. That is called an incremental budget. Understood? Yeah. Hello? Can someone confirm that it is clear?
Yes.
Okay. Right. That's called an incremental budget. Right? Or you can do what is called a zero-based budget. In a zero-based budget, you look at each and every expense item, right? And then you decide whether it is needed or it can be avoided, right? Whether it's critical to do this exercise, right? Now, for example, you might look at traveling, 55,000 bucks, sorry, 50,000 bucks this year. Next year, you will ask people to travel in their own vehicle. So you ask them to come by bus. Right? So traveling cost will reduce to 25,000. Right? And the food, you might think that last year you could have had more liquor. So let's say this is food and liquor. Sorry. I'm saying let's another line for liquor. Easy. Right. So this one, let's say 150,000. Right. Sorry. We missed liquor and no one reminded us. Okay. So incremental budget, again, 10% increase to the liquor cost. You end up with 247,500. Now, in your zero-based budget, traveling, you ask people to travel by bus or their own vehicle or motorbike or whatever. Food, you feel that last year you spent too much. This year you can give maybe a slice of bread, right? Or biscuits to all. You don't have to give barbecue, you give biscuits. And you bring down the cost to 2,000 bucks. Right? Then lodging, you don't feel like staying overnight. You might ask people, whoever who wants, who can, to get back home, and the others you can take some tents or ask them to sleep in a bus halt. Right, so $1,000 for lodging. Photography and videos, you don't have to take a professional photographer. You can use your mobile phones, zero cost. Picker, well, you feel the amount you spend is not enough, so you increase the allocation. Right, you spend for 200,000 for liquor. Sorry, let's say 250,000 liquor. And you come at a different, completely different figure. Yeah? Now, what you did in a zero-based budget is you took each and every item, you justified whether it's required, whether it can be reduced, whether further enhancements are required, and then you arrive at your budget, right? Every item needs to be justified. Otherwise, you won't get approval. But if you want, you can enhance your budget. But if you can't justify, no approvals. Okay, is that clear? Hello? Any questions?
Both methods are using practical,
Yeah, very much. These are the most common budgets. Eh?
So the total may be the lower than the 2022 budget also, no? Sometimes.
Yeah, it can be lower.
Okay.
It need not be higher. Right? The zero-based budget, the objective is to make sure you can justify your expenses. If you can't justify, you don't get any allocation like this. Right? Any other questions? No? All right, so can someone confirm that it is understood?
Yes.
Okay, good. So let us move on. By the way, next week you may not have classes, but I will inform. Most likely, your class next week might get cancelled. Eh? So the two main budgeting techniques are called incremental and zero-based budgeting. Incremental budgets are budgets in which the figures are based on those of actual expenditure for the previous year, with a percentage added for an inflationary increase for the next year. This is an easy method to save time and preparation cost, but it is the lazy way of doing and is often inaccurate. It's a very lazy way of doing it. All you have to do is take last year's budget, last year's actuals, and put an increase. It prevents conflicts between department managers since a consistent approach is adopted throughout the organization. Right? So you're not discriminating between departments. You're giving everyone the equal treatment. The impact of changes can be seen and traced quickly. This budgeting technique is only suitable for organizations where each year is very similar to the previous one in terms of activities. It assumes that all current activities and costs are still needed without examining and justifying them in detail. Very few dynamic organizations or projects are so stable that this budgeting technique really works for them, as it's very difficult to say that an incremental budget will fit everyone. There is no incentive to try and reduce costs, and performance targets are often unchallenging. Right, shall we try this example? Okay, done. A bank will have a sizable amount in its budget for staff salaries. In one particular year, staff salaries were 1.5 billion. When the budget is being prepared for the next year, the CEO thinks that he will need to employ two new senior managers who will be paid a salary of 500,000 each monthly before any pay rises. And also that he will need to give all staff members a pay increase of 10%. Assuming that the two new staff will receive the increased pay levels, calculate his budget for staff salaries. How much did you get?
$1.6511.
Okay, let's see. It's 1.5 billion. So let's calculate in thousands. Senior managers. Two senior managers. 500,000 each. Comes to 12 million. So everyone will get a 10% increase. Is this what you get?
Excuse me, sir. How did you get the senior manager's one, 12,000?
They're paid 500,000 monthly, no? Right? Each of them. That means monthly, both of them will be paid 1 million, 12 million for the year. Right? And that will increase by 10%. Am I right? Got it? Yeah.
Okay, sir.
Yeah. Anyone else? Any questions? No questions? Right, so zero-based budget. Earlier we did incremental, now zero-based budgets. In zero-based budgets, past figures are not used as starting points, right? So you never start with last year's figure. The budgeting process starts from scratch with the proposed activities for the year. The result is a more detailed and accurate budget, but it takes more time and energy to prepare a budget in this way. This technique is essential for new organizations and projects, but it is also probably the best route to go in a dynamic organization that is proactive in taking on new challenges. Right, so when things are dynamic, this is a good thing to do. Every departmental function is reviewed comprehensively, with all expenditure requiring approval, rather than just the incremental expenditure requiring approval. Zero-based budgeting tries to achieve an optimal allocation of resources to the parts of business where they are most needed by forcing managers to justify every activity in their department. Until they do this, the budget for their department is zero. A questioning attitude is developed by management who are constantly forced to ask themselves questions such as, is the activity really necessary at all? What happens if the activity ceases? Is the current level of provision adequate? What other ways are there of carrying out activity? How much would the activity cost? Do the benefits to be gained from the activity at least match the costs? All of these questions are largely answered by breaking the budgeting process down into 3 distinct stages. Activities are identified by managers. Managers are then forced to consider different ways of performing the activities. These activities are then described in what is called a decision package, right? Remember how we planned the trip? We considered each and every item to see whether they were absolutely necessary or whether there isn't another way of doing it, right? So these decision packages analyzes the cost of each activity. It states the purpose, identifies alternative methods of achieving the same purpose, establishes performance measures for the activity and assesses the consequences of not performing activity at all or of performing it at different levels, representing the minimum level of service or support needed to achieve the organization's objectives. Further incremental packages may then be prepared to reflect a higher level of service or support. While some form of cost-benefit analysis may be useful at this stage, a degree of quantitative analysis must also be incorporated. Management will then rank all packages in order of decreasing benefits to the organization. This will help management decide what to spend and where to spend it. This ranking of decision packages happens at numerous levels of organizations. For example, should the senior managers be recruited, right? In the previous example, we saw that the company is planning to recruit 2 new senior managers. So zero-based budgeting will question that. They will check whether these guys really need to be recruited or whether you can use someone to double hack. Resources are then allocated based on priority, right? So it's very important that you prioritize. Drawbacks of zero-based budgeting. Departmental managers may not have the necessary skill to construct decision packages. They will need training for this, and training takes time and money, right? Now, zero-based budgets, look at the zero-based budget. Okay, so in a zero-based budget, everything has to be justified, right? So certain departments might be able to justify, others might not be able to justify. But the department that cannot justify may be as equally important as any other department, right? So they might get demotivated. But it has a questioning attitude, right? So it can result in, if properly implemented, in cutting down lots of costs, unwanted costs. Okay, now the other thing is there might be cross-functional relationships. So if you cut the cost of one department, it might have an adverse impact on the cost of another department. Now, if you cut down the marketing budget, it might have an adverse impact on sales. Okay. Then there might be things like everyone in the organization is not getting the equal treatment. That is how employees will consider it. In large organizations, the number of activities will be so large that the amount of paperwork generated from zero-based budget will be unmanageable. So if the company is very large, lots of interrelationships exist, very difficult to do it. Because, as I said, there might be adverse impacts which cannot be quantified. Right? Ranking the packages can be difficult since many activities cannot be compared on the basis of purely quantitative measures. Qualitative factors need to be incorporated, but this is difficult. Top management may not have the time or knowledge to rank what could be thousands of packages. This problem can be somewhat alleviated by having a hierarchical ranking process, whereby each level of manager ranks the packages of the managers who report to them. The process of identifying decision packages and determining their purpose, cost, and benefits is massively time-consuming and costly. One solution to this problem is to use incremental budgeting every year and then use zero-based budgeting every 3 to 5 years, or when a major change occurs. This means that organizations can benefit from some of the advantage of zero-based budgets without an annual time and cost implication. Another option is to use zero-based budget for some departments, but not for others. Certain costs are essential rather than discretionary, and it could be argued that it is pointless to carry out zero-based budgets in relation to these. For example, electricity costs in a bank are expenses that will have to be paid, irrespective of the budget amount allocated to them. Incremental budgeting would also seem to be more suitable for costs like these, as with building repair costs. Since decisions are made at a at budgeting time, managers may feel unable to react changes that occur during the year. This could have a detrimental effect on the business if it fails to react to emerging opportunities and threats. The organization's MIS might be unable to provide the necessary information. It could be argued that zero-based budgeting is far more suitable for public sector than for the private sector. This is because, firstly, it is far easier to put activities in decision packages in organizations which undertake set definable activities. Local governments, for example, have set activities including provision of housing, school and local transport. Second, it is far more suited to cost that are discretionary in nature or for support activities such costs can be found mostly in non-profit organizations or the public sector or in service departments of commercial operations. The other one is to have rolling budgets. So any questions on zero-based and incremental budgets? Those are the main two budgets, right? Those are what you need to know. The others are only for your information. So a rolling budget can be something like a 3-year rolling budget. What you do is you prepare budgets for 2022, 2023, 2024. You do 3 years of budgeting. So after the 2022, you drop 2022 and you add 2025. So you have another 3-year budget. And so when 2023 is done, you drop 2023 and you add 2026. Likewise, you keep rolling it. That's why it's called a rolling budget. At any given time, you will have a budget for 3 years. That's called a rolling budget. A rolling budget is also known as a continuous budget, a perpetual budget, or a rolling horizon budget. And the bank's accounting year ends on 31st December. Prior to the start of 2013, the bank prepares its annual budget, which is detailed by month for January through December. This budget could become a rolling budget if in January, the bank drops the budget for January and adds January 2014, the next year. This rolling budget now covers 1 year or 12 months period from, right? So it can be a 3-year or a 3-month. But either way, you have to drop the latest one and add a new one. And that's called a rolling budget. So it can be quarterly, monthly, or annual. It can even be a 5-year rolling budget. Activity-based budgeting. Right? It's based on various activities carried out in an organization, maybe marketing, right, or sales. So for each activity, you allocate budgets. Activity-based budgeting is a method of budgeting in which activities that incur cost in every functional area of an organization are recorded, and the relationships are defined and analyzed. Activities are then tied to strategic goals, after which the cost of the activity needed are used to create the budget. Activity-based budgeting can help firms create more accurate financial forecasts. In contrast to cost-based budgeting practices in which the prior period's budget is simply adjusted to account for inflation or revenue growth, activity-based budgeting provides opportunities to align activities with objectives, streamline costs, and improve business practices. By looking at the cost structure of an organization via the processes that are actually being performed, managers can more effectively analyze the profit potential of a company's products and services. Cost efficiencies can be found by comparing activities performed in different areas of an organization and consolidating or rerouting certain functions. Zero-based and activity-based budgeting comparison. Zero-based budgeting is a method where all expenses had to be justified for every new period. Right. So this is a comparison between zero-based and activity-based. Zero-based, you have to justify every cost, right? Activity-based budgeting is a budgeting method where all activities that invite cost in all function areas of an organization are recorded and the relationship between them analyzed. In zero-based budgets, all functions in an organization are analyzed for its need and costs. Zero-based budget can be termed as reevaluation of program and expenditures of an organization. Activity-based budgeting aligns all activities with objectives, and it helps effectively analyze the profit potential of an organization's service and its products. Then line item budgeting. This is where you take the P&L and you go to each and every line and do a budget for that, right? So you have the revenue budget, then the cost of sale budget, gross profit budget. Likewise, every line you have a budget. It offers decision-making, a step-by-step approach to budgeting. Budget makers can use line item budgeting to make a specific decision, such as changing funding levels of programs being phased out to provide money for new programs, or making cuts to budgeted expenses because of changes in organizational policies. It is easy to make. Simply list all expenses, giving each item its own line and specific amount. This is why many organizations, especially very small businesses, choose line item budgeting. It is straightforward and does not require linking budgeting advanced accounting, such as activity-based costing or management practices such as performance-based budgeting. Micro-level expense control, right? These are the benefits of line item budgeting. Easy to make, very easy, right? You will not miss anything, right? Because you are covering the essentials. Micro-level expense control, under each line item, you know, you can drill down further and you know how to control the expenses. There's flexibility in controls, right? You know, by reducing your marketing budget, you might have a detrimental effect on your sales, right? So like that, you can have flexibility in your controls, and you can rely on past data. You can do a statistical analysis. Performance-based budgeting, use statements of mission, goals, and objectives to explain why the money is being spent. It is a way to allocate resources to achieve specific objectives based on program goals and measured results. The entire planning and budgeting framework is result-oriented. There are objectives and activities to achieve these objectives, and these form the foundation of the overall evaluation. Performance budgeting comprises the result, the strategy, and the activity or the output. It is possible to understand which activities are cost-effective in terms of achieving the desired results. Performance-based budgeting is a way to allocate resources for achieving certain objectives. It sets goals or a set of goals to which monies are allocated. Right? So things like balance scorecard and KPIs are parts of performance-based budgeting. Okay, right, so that's it in terms of budgeting. Any questions? What you need to know are zero-based and incremental budgets. That's if you understood that, it is more than enough. No questions? Right. The next one is on evaluating portfolio performance. Performance evaluation. Now, if you're managing a portfolio, your portfolio might have various kinds of assets. You might have maybe bonds, equity, fixed deposits, right? All sorts of asset classes. You would have invested in many asset classes. Maybe you might have an equity portfolio, right? So if you have all of these kind of assets, how would you measure performance? That's what we are going to discuss. Performance valuation improves the effectiveness of a fund's investment policy by acting as a feedback and control mechanism. It does the following: shows where the policy and allocation is effective and where it is not. It directs management to areas of value added and lost. Right, so measuring performance. Why is performance measurement important? These are the reasons. You know exactly what you're doing right and what you're doing wrong, and you can reward the good performance. You can maybe penalize or discourage poor performance. You can give recognition and better training to your staff. You know exactly where they're weak and what needs to be improved. Right? Then you can allocate your resources more efficiently. It quantifies the results of active management and other policy decisions. Right? So active management means you actively manage your portfolio. You don't become a passive investor. That means you don't follow maybe an index. You're not an index fund. You're an active manager. You try to outperform the index. It indicates where other additional strategies can be successfully applied. Performance measurement to calculate rates of return based on changes in the account's value or over a specified time period. Performance attribution to determine sources of accounts performance, and performance appraisal to draw conclusions regarding whether the performance was affected primarily by investment decisions or by the overall market or by chance. Right, so what caused or resulted in the performance? How did you achieve the performance that has been achieved? Was it the market as a whole? Overall market has gone up, right? Or did the sector go up? Or was it your sheer performance alone? It was, if the market the whole market goes up, and let's say the whole market, entire market, all share price index is up by 50%. Right? Let's say, for example, your portfolio is up by 20%, right? For the year, your portfolio is up by 20%. Fantastic achievement. But if you take the index, if it is up by 50% and you have achieved 20%, that means you have underperformed the index. The index has done better than you. But on the other hand, if the index has done 30% and you have done 50%, then it's a different story. That means you have done better than the index. Right. So this is how we calculate portfolio return components. The portfolio return can be broken up into three components: the market component, style component, and the active management. Right. So your portfolio return is equal to market plus style plus active management. The contribution comes from all three of these pillars, from the three pillars: market, style, and active management. Now, market means the overall market, right? So if the overall market is doing well, it contributes to your portfolio as well. Your portfolio also goes up. That's the return attributed to the market. Then the style is from the market, you pick and choose where you want to invest, in which sectors you're going to invest. Right. That means you might prefer maybe the freight sector. So you invest in maybe the Expo Lankas and all that, or you invest in the dollar revenue companies, right? Or the dollar asset companies. Right. So that's your style. The active management means you try to maybe short sell, which is not allowed in Sri Lanka, but assuming it is allowed, you short sell or you overweight certain sectors. Within the selected sector, you overweight, right? Or you do active trading. That is active management. Okay, so your portfolio performance will be the market return plus return due to style and your active management. Then the return due to style is the benchmark minus the market return. Let's say your style can be positive or negative. Then your active return is portfolio return minus the benchmark return. Active return is the difference between the manager's overall portfolio return and the style benchmark return. Right, so let's try this example so that you will understand better. The Palestine account has a total monthly return of 5.04%. Right, so the portfolio return is 5.04%. During the same period, the portfolio benchmark returned 5.32%, and the market returned 3.92%. And the benchmark was 5.32, Your portfolio did 5.04. That means the benchmark has outperformed the portfolio, right? You have done something wrong. The market index returned 3.92. So the market was 3.92, but you have done 5.04, which is better. Good. Calculate the amount of the portfolio return attributable to managers, active management, and style. So you need to use those equations. Benchmark return, portfolio return 5.04%. Benchmark return 5.32%. Market return 3.92%. You have been asked to calculate active management and style. So let's put it in this equation, 5.04 style is equal to portfolio minus market minus active return. And active return, the portfolio minus benchmark return. Portfolio return 5.04. So active management comes to 0.28, isn't it? You can even use this equation. Because portfolio return 5.04 minus market return is 5.32 minus active management is minus 0.28. So this is 3.92. Okay, so any questions? Now, for example, let's say you all are managing a 100 million rupee portfolio, right? You have been given to manage 100 million rupees. So that is your portfolio. And your portfolio has given you a return, in this case, 5.04%. Then your benchmark, let's say you're benchmarking it with the EPF return, right? EPF has returned 5.32%. That means your portfolio is giving 5.04, whereas EPF giving 5.32. So EPF has done better than you, right? Then the overall market, let's say the share market, entire Sri Lankan market return is 3.92%. So the question is, what is the return due to your active management and what is the return due to style? And so style can be investing in fixed income, right? Or investing in market cap, penny stocks, something like that. That could be your style. Then active management means you keep trading, right? You don't stay static. You don't do an index fund. You do active trading. That is due to return due to style. Okay, so you have to remember all of these equations. Any questions up to now? No questions? Then the benchmark. It's a standard against which the performance of a security, a mutual fund, or an investment manager can be measured. Generally, broad market and market segment stock and bond indices are used for this purpose. Right, so it is a tool which against which you can measure your performance. Properties of a benchmark, it has to be specified in advance, right? You can't tell the fund manager that the benchmark is the EPF return. You can't tell, you have to tell it at the beginning of the year, not at the end. So you have to specify in advance. Then it has to be appropriate, right? So if you are managing a real estate market and the EPF does not invest in real estate, then you can't use EPF as a good benchmark because it's two entirely different portfolio. Then it has to be measurable, or you can't even use maybe the return generated in the US market, right? So it has to be appropriate, then measurable. It has to be quantifiable. You can't be vague. You can't say your return has to be a good return. You have to be able to measure it, maybe a 10% return for the year. Unambiguous. No, everything has to be very clear. It's important that clarity, there is clarity, right, in your benchmark. Reflective of the manager's current investment opinions. It has to be a reflection of where you're going to invest in, right? So if you're investing in the Sri Lankan market overall, fixed income and equity, then ETF might be a good benchmark. Accountable. You have to be responsible for the performance of the fund. Once you agree, investable, you have to be able to replicate the benchmark and forego active management. Right? Meaning, if you think you're not going to actively manage, and you should be able to replicate the benchmark in your portfolio. Constructing a benchmark, you identify the important elements of the manager's investment process. Right? Identify the elements. Select securities that are consistent with that process. Weight the securities. Review and adjust as needed to replicate the manager's process and results. Then you rebalance the custom benchmark on a predetermined schedule. Okay, so that's on performance measurement. Any questions? No questions? Hello? Any questions on that? No.
No, sir.
Let's move on to ratios. Those of you who are familiar with finance and have reasonable understanding, how some of those of you who have analyzed your customers' accounts and all that, will be very thorough in this area, right? Ratios. Why do you use ratios? Why ratios?
For trend analysis,
Excellent. Maybe to analyze trends. Your profitability is increasing or is it reducing? Your gross profit, maybe your gearing is increasing over the past few years or is it dropping? Then what is happening to your finance cost? Then your dividend payout remains the same or is it increasing? You can do trend analysis. What else?
From a investor's perspective, whether to make investment or pull out the investment made.
Excellent. So you can make entry or exit decisions. You can compare with your competitors. You can decide whether you're doing better than your competitors or doing worse than your competitors. Right now, for example, if you're in the banking sector and you look at maybe Bank of Ceylon, right, the biggest balance sheet in the country, and you are working for a small bank, Bank of Ceylon maybe makes a 10 billion rupee profit, right? You're making only 1 billion rupees. Now that might be difficult to compare. No? Your 1 billion against Bank of Ceylon's 10 billion. Why? Because two different sizes, right? Now, eventually, size does not matter, but in some cases, like this, size also matters, right? So, yeah, ratios will remove the distortion size. Advantages and disadvantages. What are the disadvantages? Possible disadvantages of ratios?
Considers the past record only, not the future ones.
Okay, so good. History might not repeat itself.
Inability to compare the performance if the industry is different.
Yeah, very good. And future might be different. So you cannot compare across industries. Right? So you can't take a hotel and compare it with a hospital. Right? You can't take a bank and compare it with maybe an insurance company. Right? might not be directly comparable. They are operating in two different industries. Anything else? No. So certain ratios that we can look at, right? One is the liquidity ratio. What do you mean by liquidity? Now, those of you who are married, right? If you're married, you know before you got married, you're what? Liquid or illiquid? Before getting married,
Liquid, sir.
liquid. Then after getting married, then you become more liquid, right? So that is liquidity. Okay. So in financial terms, what it means is, let's say you have wealth of 100 million bucks, right? And you have a property, all 100 million bucks invested in property, nothing else, no cash. Now, if you want to buy a loaf of bread, right, only way you can do it is to sell part of your land and buy bread, right? How easy is it to sell land? Very easy, or it takes time?
Takes time.
Takes time. It takes a lot of time. But let's say you have 100 million bucks and entire 100 million bucks is under your bed, right? You want to buy a loaf of bread, you just take it and buy a loaf of bread. It's simple as that. But if you take the return, maybe the return you generate on the land might be very high, right? But how much return does cash generate? The cash under your bed generates
Nothing.
zero, no return at all. Okay, so liquidity and profitability are at the two extremes. The higher the liquidity, lower the profitability. So liquidity means how easy is it to convert from one asset to another kind of asset, right? The convertibility, not necessarily to cash, could be to other asset, right? Now, in that case, the plot of land being converted into a loaf of bread. So one asset being converted into another asset. Okay, so the ability or the ease to convert is called liquidity, measured by liquidity. What is leverage? Leverage means the amount of borrowing, right? So is leverage good or bad? Now this has been tested quite a few times at your exam. Leverage, the concept of leverage. So let's spend a minute or two on leverage. Now leverage means you borrow and invest, right? So if I may explain using an example, let's say you had 100 of your own money, 100, right? It could be 100 million, 100 billion, whatever you want. Let's say it's 100. And you placed it in an investment which gives you a return of 10%. And so after 1 year, what is the return you get? How much return will you get? After 1 year, what return will you get? Hello. In 1 year, what is the return you get?
110.
Yeah, you get a return of 10. Interest only. Yeah? Now let's say you borrow at, assume at 8%. You borrow $1,000 at 8%, and you put it in the same investment, which gives you a return of 10%. So you get additional 100, right? And the borrowing cost at 8%, for which you need to pay 80. Which means your net return comes to 30 with the original investment. Okay. Now after 1 year, your investment matures, so you can settle your loan. And this part goes off. And you will be left with the original investment amount, original investment, and the net return of 30. Now, what is your overall return? Your return on investment? How much? What would be your return on investment?
110.
No. See, on your original 100, you got 10. No? Then you borrowed 1,000 and invested in the same thing. Net return, you get 30. Right? You get a return of 100, you pay interest of 80. So out of this, you get 20. So total return would be 10 plus 20, 30, isn't it? All right. That is your total return. Understood? That means your return on investment would be 30 divided by the original investment of 100, which gives a 30% return. Understood? Is this right or wrong?
Right.
Right. It means now if you hadn't borrowed, your return would have been only 10%. Because of this borrowing, it increased to 30%. Now, what if all of a sudden your borrowing cost goes up? You're still in, let's say it's 12%. It goes up to 12%. What if I borrow 12%? The return is the same. Your return remains the same. whereas your borrowing cost goes to 120, right? That means your overall return is minus 20. Your return on investment, original investment is 10 plus minus 20 is minus 10. Now your return has dropped from 10% to minus 10%, isn't it? Okay. That's clear? Borrowing and investing. Right, this process is called leverage. So leverage is good or bad? What do you think? Is leverage good or bad?
As long as it gives us more return than what
Yeah,
we borrow.
exactly. Leverage is good for as long as your yeah, you're quite right. Leverage is good for as long as your cost of borrowing is lower than your return. And so if your return is more than the cost of borrowing, leverage gives you fantastic results. Understood? Any questions? So that's leverage. You can have leverage ratios as well. Then activity ratios, like what we have discussed already. Days inventory outstanding, days sales outstanding, right? Remember? Cash conversion cycle and profitability ratios to measure how making profits. Right, so liquidity ratios. First one is called current ratio. Very simple. Current assets divided by current liabilities, called current ratio. Now, current assets can be subjective because it includes stocks, right? Stock valuation is a controversial topic. Very difficult to value stocks because it's an asset which is between the final product and the raw material, right? So it's somewhere in between. How do you assign a value? In between value. Do you give 100% of the finished product value, or do you give 50%? Do you give 30%? How do you decide on the percentage based on the level of completion? Right, so valuing stocks is very difficult. Now, to eliminate any controversies, what you can do is you can remove the element of stocks. Right, so it is that ratio is called the quick asset ratio or acid test. Current assets minus stocks divided by current liabilities. Now, if you take a company like Toyota, they maintain zero inventory, no stocks at all, just in time it is called. Right? It means stock element is zero, in which case the current ratio will be equal to the acid test or the quick ratio. Clear? Next kind of ratios are called leverage ratios. Leverage we just studied, it's called debt to equity. The first one is debt to equity. That means your debt divided by the total equity. Okay, so debt in a company divided by the equity. Then you have gearing, which is the long-term liabilities divided by your total borrowings, the total liabilities, long-term liabilities plus equity. That's called gearing. Activity operational ratios we have already discussed, right? Debtors days, creditors days, stock base, debtors turnover period, remember, stock turnover period, creditors turnover period. Then you can calculate cash conversion cycle, which is your debtors days plus stock days minus creditors days. And your profitability ratios, your gross profit or net profit margin. How much of gross profit are you making for a unit of sale? Or how much of net profit are you making for a unit of sale? Then asset turnover is your turnover divided by assets. Return on capital employed, profit before interest and tax divided by capital. The return on capital employed can be segregated into three components, right? There is an alignment issue in this, sorry about that. It's actually your profit before interest and tax divided by capital, right? So what you do is you take your profit and before interest and tax divided by sales, which gives your gross profit turnover. Gross profit margin. Then sales divided by your assets, right? Sales divided by asset is asset turnover. Then assets divided by your capital is called your margin or your leverage, right? Return on equity is your profit after tax divided by your equity. Okay. Then investment ratios. And this is ratio which we did not cover earlier. It's ratios like your price to earnings ratio. Remember a couple of weeks back we discussed this. Your PE ratio, market price divided by earnings per share. Okay. And based on that, you can decide whether a share is undervalued or overvalued. Now, this example I have given is quote extracted from the set of slides that we did a couple of weeks back. PE ratio, very important investor ratio. It's something that investors will look at. What is your PE? Price divided by earnings per share. Then your dividend cover. How much of dividends are you paying? How many times your dividends can cover your, how many times your earnings can cover your dividends? That means if you are earning 10 bucks, that's 1 divided by 10, 10%. That means you're paying 10% of your earnings as dividends, right? Sorry, it's called dividend payout, right? That's a payout. You're paying 10% of your dividends, 10% of your earnings as dividends, the dividend payout. On the other hand, every year your dividends can cover your earnings can cover your dividends for 10 years. Now, if you earn 10, 1 you're paying as dividends, then 10 divided by 1 is called the dividend cover. That means your dividend is good enough to cover your earnings is good enough to cover your dividends for 10 years. So it's earnings per share divided by dividends per share. Okay, to practice these ratios, you all can use each of those equations and calculate, right? So I will leave that for homework, very simple calculations. And with that, we can conclude today's session, right? So any questions before we wind up? Okay, so if there are no questions, we can close for today. And I will see you not next week, but the week after. All right. So thank you very much. Stay safe.